The following presentation is for educational purposes only. There is no recommendation to buy or sell security. We're going to be taking a look at this inside TradeStation in a minute, but I just want to review some information and facts about volatility and volume. I think both volatility and volume can be used with futures, but today's focus is really on stocks. And those two tools are, I think, they are misused and they are misunderstood, and for this reason most traders really don't use them. One exception is Mark Leibovitz, who is famous for his volume reversal fame in picking stocks. He's got a proprietary tool called volume reversal, which he uses for picking stocks. It's his main tool for indicating when stocks should be bought or sold. So just the fact that he is one of the number one or two market timers and has been so for 20 or 30 years indicates there is information in volume which is useful and helpful, but it's just packaged poorly inside TradeStation for ordinary users. What I will be showing you has nothing to do with the work that Mark does, but is actually very helpful nonetheless. So both volume and volatility have issues that really prevent it from being helpful to traders, but both can be correctly implemented to give you an edge, and I'm going to show you how to do that today. But doing so really requires an understanding of the limitations of both volatility and volume. So you're going to want to include these in your approach to strategy development or in your approach to trading in general if you're not an algorithmic trader. So these two techniques provide two extra dimensions of symbol behavior and will help you avoid the trap of using too many price-based filters. Price-based filters, typically moving averages, Keltner channel, Bollinger Bands, RSI, stochastic, all of them are primarily invested in giving you clarity about the direction of price movement or the extremity, price extremes. Volatility and volume tools will not help you in either of those areas, nor will conventional tools help you in the areas where volatility and volume are important and are useful. Volatility and volume are used in a separate area in terms of where they're used and how they're used. So there are many ways to really look at stock price movement with volume and volatility, and we're only going to look at using them in one particular way, one area. I'm not going to cover a whole bunch of different techniques you can use with volume and volatility. We're just going to cover one of them. So I'm just going to sort of in general discuss how stock prices move, and they really move most of the time. They fluctuate without signaling any future direction. Sometimes they actually move and react very quickly, instantaneously moving from one level to another where they then stagnate at that level or fluctuate at that level. But a small percentage of the time they actually trend, and that trend is usually based on sentiment or business conditions or economic conditions, if you will. So sentiment might be where there is a belief that a technology will yield some improvement in an area, or Donald Trump will get elected and will build the Great Wall to our south, and therefore cement becomes a good investment. That's a kind of an idea behind sentiment, whereas business conditions might be economic events take place where suddenly, say for instance, oil becomes more expensive than it has previously, and therefore businesses which rely heavily on oil, their costs might be greatly affected, and perhaps airline stocks would do poorly or worse as oil rises, whereas other stocks, particularly oil service companies or companies that sell oil, might do actually better. So we're really only interested in identifying the stocks in this third category. What I'm basically seeing is that trends are often preceded by a combination of high volatility with volume spikes. And you have to have both at the same time, or roughly the same time. The direction of the trend that follows, however, is uncertain and really must be sorted out by the trader. So I'm really only looking at daily data, and I'm not really suggesting that this technique works on intraday data. It may or it may not. I don't really have an opinion on that at this point. So just as an aside before we go into this whole thing, my experience with trading stocks is it's better to be market neutral, sector neutral, which means basically pick a stock which you think you have a reason to believe has a strong tendency to appreciate in value in a sector, and then pick a similar stock in the sector, in the very same sector, that appears to be weaker, and play both of them. You buy one and you sell the other. That way in equal dollar amounts. And you end up, therefore, being market neutral, sector neutral. Market neutral used to be a good idea, but you really need to be sector neutral, because big firms that trade stocks can switch from one sector to another. And for instance, if you're decide to be long a growth sector, you could get killed if suddenly there becomes a need for firms to become defensive and they dump their growth stocks and buy defensive stocks. So I really think the safe way to play this is to be market neutral, sector neutral. And so when you see my recommendations, they're not necessarily suggesting that you be long a stock or short a stock. They're saying this is a candidate for examination in perhaps a spread trade. That's what I want you to think about. So now let's talk about volatility a second. So back adjusting stocks distorts the price action of prior history, and this is really typically done by stock splits. When a stock splits, say 2 for 1, the old prices are all divided by 2 and compressed. The data gets compressed, and so if a stock has split numerous times, you can go back and look and see that's, oh, here's a stock that was trading 15 years ago for 8 cents. Well, it never ever actually traded for 8 cents. It's just a number of stock splits have forced the price down into this price range, so that you can build a continuous chart out of it. So that causes problems for anyone doing technical analysis. So comparing the old price action to current price action requires normalizing the data, and this can be done with the average true range comparison. So the range of a daily range is the high minus the low, and the true range is actually includes any gap that occurred from the prior bar. So specifically, I compute the average true range of 5 bars divided by the average true range of 50 bars as computed 5 bars ago. And so the ATR 50 of 5 bars ago is my normalizing computation. So with that ratio, I look to see if the current 5 bar ATR has risen above 1.4, which is somewhat of a subjective measure, but it begins to tell me that there is a move toward relatively high volatility. We now need to combine that with a volume spike for us to have a confirmation that something important is happening. Now, volume has its own issue. I think if you look at the TradeStation library, you might find 500, or if you have a big library, you might find 1,000. I have over 5,000, but some of the libraries will have quite a few tools that are either come with a default package of TradeStation or custom design tools to measure price movement. And yet, you may find only 1 or 2 or 3 volume tools, and one of them happens to be on balance volume. And personally, I find on balance volume to be a rather inadequate tool, and it doesn't provide a sufficient measure of that I find particularly useful. Now, volume can change over time, and you can go from a low volume of, let's say, 200,000 shares a day up to 2 million shares a day, or even higher. And so you get these multiples of volume, and that makes that tool measuring volume somewhat difficult to work with. So I work with the log of volume, and that's particularly because I'm interested in relative volume, which is more important than absolute volume. So I'm interested really in extreme volumes events as defined by the log of V, log of volume. And we can use the Bollinger Band tool to look to see when the log of V has exceeded the upper 2 standard deviation Bollinger Band. So when you have one of these events where volume blows out and you get an extreme move, you will see that the log of V is exceeding the upper 2 standard deviations, and you will see oftentimes the Bollinger Bands ballooning out. So because the volatility computation takes place over 5 bars, the volume component can occur anytime over the last 5 bars. Doesn't have to happen on the same bar where the volatility finally pushes to an extreme level. So there's a timing issue in this. Just keep that in mind. Now, I said that this is primarily works with stocks. It can work with futures symbols, but there's a problem with futures data. The volume information on futures data has some screwball issue on the day of the rollover of the contract. And because of that, you get this ridiculously low volume reported on the date of the rollover of the contract. It doesn't matter how you roll it. You can roll it on the day of expiration, 2 days prior to expiration, 8 days prior to expiration, or 10. It doesn't matter. For some reason, TradeStation reports a screwball low volume reading. That lowball screwy volume reading becomes an extreme event, which is then reported by the Bollinger Band as being an extreme volume event, and completely distorts the results. So the indicator becomes practically useless. So there are ways to fix that. I'm not about to cover that in this issue, this webcast. It's too complicated, but there are fixes for that sort of thing. I've picked a bunch of stocks. I went through the the NASDAQ 100 and the S&P 100 to take a look at a list of stocks which might be of interest right now. And I'm going to make a very bold prediction about these stocks as to whether or not I think there is a better upside potential or better downside potential. And you remember, please keep in mind that the way I described that the safety of trading is to spread trade. So here's an example of a stock, Apple, and we would be looking for volatility here. Here's my red dotted line. That is a volatility event when your pink line is above this red dotted line. This dashed line is 1. So low volatility is below this, higher volatility is above this. When it gets to this red line, that's my 1.4. So here we have, right here, is a high volatility event occurring at the exact same time I have a volume event. And the volume is actually quite a bit above the standard deviation, and you notice that the upper channel and the lower channel are ballooning out. So there was indeed some follow through to this event. This was Apple back on 4/27, and we noticed that there was a bit of follow through until it finally bottomed down here and began to recover and went sideways for some period of time. We have some other volume events going on here, but we're not really interested in those unless they're accompanied by a volatility spike. And the volatility spike occurred back here on July 27th. At the same time, another volume spike occurred. This occurred with a gap up situation. This happened to be then followed by further price appreciation, which is basically what I was suggesting in terms of the ability of these two tools, the combination of these two tools together to forecast the continued price movement. Now, sometimes we don't know immediately which direction this is going to head, and you're going to see that as we go along here. More recently, as of September 14th, we had basically a breakdown, an attempted breakdown in price, immediately followed by a strong reaction to the upside. This is essentially a fake breakout to the bottom with a very strong move higher. So right here on this bar right here, which is on September 13th, you get this. Actually, you've got volume spikes all through here. So I'm going to just pull this over here. So take a look at this volume down here. You see, there are some rather extreme amounts of volume coming in to Apple during this period of time. At the same time, you're getting extremes in price movement. And so this is a little too early, and right about here is when this thing should have caught your eye. This movement here down and back up again is a V-shaped formation coupled with volatility and volume and a fake breakout to the downside. Extremely powerful and should have caught your attention. I'm seeing how this has behaved over the recent 2 or 3 months. My bet is that this stock is probably going to move higher. I have Adobe here. Let's take a look at Adobe. This is again a V-shaped formation coupling with a volatility and volume spike right here back on June 22nd. And just over the last few days, we have had a volume spike right here coupled with a volatility spike to the upside. And even you'd have to look at this chart and think this is a fairly strong stock. Back here in what happened back here in February was basically a V-shaped bottom that took place on extreme price movement and volatility. The formation was, the down move was over in 2 days and recovered from that. So there's a lot of strength in these moves higher. I'm particularly impressed with this most recent up move. I would bet on this stock moving higher. AMAT, Applied Materials. We have just a string of these moves over the last few months, starting here back in on May 20th with a gap up, volatility, and volume spike setting up for future action. This happens to be a little V-shaped formation. Did indeed have a volume spike right there, and that would be on June 24th, followed with some more follow through. Again, another volume spike here on this gap up. Everything about this tells me that this is still a very strong chart. I would be leaning toward higher prices in AMAT. Here is Amazon, a rather strong looking chart. I think you can all imagine that, but you could have picked up this volume and volatility spike right here back in April. We get another series of volatility spikes here, a couple here, and coupled with a volume spike right there. So this has had some follow through. I think this is a strong stock. Caterpillar. This has had a volume and volatility spike as of today. And you look at this chart, yes, back all the way to the beginning of this year, this stock has been doing well and continues to do well. I have to think that this stock is going to be moving higher. This is ConocoPhillips. Today, we have a volatility and volume spike right here on a stock which basically has been meandering slightly lower, but for reasons which will soon be obvious, I believe this is a good opportunity on this stock to move higher. Here is Federal Express, a gap up recently here on September 21, coupled with volume, a substantial volume spike tells me that this is a strong situation, is likely to move higher. Here is another energy-related one, Halliburton. Today, volume spike with volatility spike. So we're now beginning to see this sector, the energy sector, is breaking out in a strong way. These, if it was just one stock, I would be a little more hesitant, but as you're going to see, there are others in this energy group which are breaking out. Here is Intel. Interesting situation here, strong all year long. We had a V-shaped formation back here on June 24, where there was indeed a spike in volume, but not a dramatic spike in volume, and a volatility price action as well over several bars. It collapsed and immediately retraced. And when it got to this level right here, you had to be thinking higher prices just by this extremely powerful V-shaped formation. Indeed, higher prices took place just over the last few days. Going back about 10 days ago, we had a major volume spike on this, and coupled with a volatility spike, I have to think Intel is going higher. Here is Occidental Petroleum. Again, another energy-related group. Something is going on in this group. I don't know what it is. I am not paying that much attention to the machinations of what causes these sectors and stocks to move higher. But take a look at this. This again is a confirmation that yesterday we had a spike in volume coupled with a spike in volatility, and that follows what was a relatively high volatility situation here, but no spikes in volume. So this spike in volume here tells me that there is something more important going on, and that this V formation is going to push stocks higher. Perhaps the most interesting of all of the stocks I've looked at here is Procter & Gamble, P&G, strong all year long, and yet take a look at what's happening to volume down here. Look at this incredible volume. It is just ballooning out, and you get a volume spike and another volume spike and almost a volume spike and another volume spike and another, and volatility is shooting up. I don't know what is going on with Procter & Gamble, but it is all bullish. There's no question in my mind that something positive is taking place for Procter & Gamble. Not sure. Here is ExxonMobil. Again, volatility and volume spike. So there's something going on in the energy sector. I don't know what it is. Let's take one quick break here to before I go into another series of stocks. I just want to mention and keep you all abreast of what's happening. We launched our Easylanguage Learning by Example business. If the kind of material that you've been listening to today, the kind of material that you can get off of my blog on my website is of interest to you, then perhaps you would have an interest in learning how to become a programmer and do these kinds of, this is not complicated easy language programming. Learn how to do this stuff. I firmly believe that the markets are going to trend again. I don't know when. They are being manipulated, and manipulated markets tend not to trend well. I don't believe that the Feds around the world all will be able to permanently corral the markets. I think that some event, somewhere, sometime is going to cut loose, and you're going to see interest rates rising. You're going to see prices moving dramatically in all areas: stocks, financial instruments, commodities. Now is the time to get ready for those kinds of moves by boning up on how to take advantage of them. If worst comes to worst, if you're not a programmer and don't have the skills or the interest in becoming a programmer, I am also an expert at Easylanguage and can do your programming for you if that's of an interest. So now, commercials over. Let's take a look at some other symbols here. Clearly, this is 21st Century Fox in a downtrend, obviously, but I think more importantly, take a look at the reasons why this stock is. I don't think it's bottomed out. You had a volatility and volume spike here back on June 24th. It tried to recover from that, and you might have thought back here that this was some sort of V-bottom, but it never quite recovered from that. And we had another volatility and volume spike in August 4th, in which it collapsed again and really couldn't recover. And when it finally blew out the bottom here, the sign that it was headed lower. More recently, as of, well, this is September 16th, you can see a volume spike and volatility spike. I don't think, if you take a look at this volume down here, Usually when a stock has bottomed, you will see extreme volume, like this bar here or more. There is not enough volume in these bars to give you a blowout, blow-off bottom formation. I don't believe this stock has bottomed. I think it's going to go lower. Gilead Sciences, again, a stock which looks like it's meandering lower, but take a look at how it has done so. It did so here with a huge sell-off in volume and volatility. We have, again, some, and this was back in July, we have another huge volume spike, and it blew right through the bottom of this formation and headed lower, even made a new low. And today it was down. There's a volume spike here, and but we're not with we don't have a volatility spike. I would imagine that if this level doesn't hold, you are going to see another volume and volatility spike to the downside. So I would not want to be long Gilead. Here is an eye-opener. How about Coca-Cola? Let's look at this one. Got clobbered back here on high volume and high volatility. This was back in April. Another leg down here in July, on July 27th. Volume and volatility, and we have another spike in volume on September 9th. Again, the volume isn't so extreme as to give me any thought that this stock may have bottomed. I think Coca-Cola is heading lower. Here is Marriott. Now, Marriott had an interesting has an interesting chart here. This is one of these V-shaped formations. And yes, you had a volume and volatility spike back here in June, and it did recover from that, blew through the top of the formation, but went kind of sideways and eventually collapsed here. And volatility began rising, and you had a volatility event, another volatility event, and right in here you have volume coming in, and it is now poised, I believe, to go lower. Nike, again, take a look at this. This is one in the immediate formation, a extreme volume event with volatility. Yesterday and today, the volatility continues to be high. Volume is down a bit, but if these levels don't hold, I believe it's going to go lower too. Looks like I have two Nikes in here. Don't need two of them. Here's Oracle. Here's a chart which has been going sideways for about 7 or 8 months now, and just recently we got this giant volume spike with a thrust down with volatility. This chart looks vulnerable. I would not want to be long Oracle. Here's Paychex. Take a look at what's happening yesterday. Volatility and volume spikes to the downside. It's this range that it's been in now for 3 months just got taken out. It was accompanied by high volatility and volume spikes actually since September 9th. So there's something going on with Paychex. This volume is building here, not quite to the exact same extent that it built when it moved higher, but there's something very interesting happening with Paychex. I wouldn't want to be long Paychex. This is Wells Fargo. Now, Wells Fargo's been in the news a lot. I don't see how anyone could be long Wells Fargo at this point, but clearly there are some people. here is a huge amount of volume going in. Take a look how ballooned out this Bollinger Band is here. You have volume coupled with volatility, and the volatility volume is rising here, and it wouldn't surprise me to find volatility spiking back up again. This is about ready to take out these major lows, the one that was set back here in February and in June. So Wells Fargo could be going lower. My bet is it will. I wouldn't want to be long Wells Fargo. And Yahoo. Let's just look at this chart. Very interesting chart. It's been strong all year long, but although we've had volume events, I really don't see a lot of volume and volatility events, except for just recently here. We are getting more and more volatility coming into this chart up here, and right here we get volatility and volume events. There is something going on with Yahoo. I don't know what it is. I would not want to be long Yahoo. Now, I'm not saying that you should be short any of these stocks unless you are trading, as I suggested, and that is pairs. Go look at Yahoo, find the sector it's in, pick the strongest stock in the sector, buy it, and sell short Yahoo. That's the only way I would play these stocks. It's never a good idea to be naked short on anything. I wouldn't recommend it. And I'm not really fond of owning any stock at this point with the way stocks are priced. But there's always going to be stocks, some stocks that move higher. And I think this tool, the tools which I've made you aware of today, can help you identify trading opportunities. They do indeed occur and are, I believe, are forecast by the combination of volatility and volume. You just have to decide how you're going to play it and which direction to go. The strongest sector right now that I would want to be is play a long sector in energy based on the moves that we've seen here in all of these energy stock. XOM, this is Occidental Petroleum, Halliburton, and ConocoPhillips. So that is really the essence of the presentation. I hope you liked the presentation on volatility and volume. If you were interested in obtaining the code to the indicators that I use for the presentation, you can come to my website at www.insideedge.net. And on the home page, which you're looking at on the right-hand side, you will see a box where you can put your name and email, and I will send you an ELD file with the code to the indicators. This will also give you a link to the free 10 free video lessons, which are available on About Easylanguage. And if you were interested in the actual Easylanguage Learning by Example course, then at the bottom of this page, there are options for you to explore it and sign up for it. I hope you learned something. This is Bill Brower. Thanks for listening.